It was about tax, uh, or depreciation and tax. Depreciation, I think you understood why we need to have the depreciation. It's because in the beginning, when we invest on machine producing products and making profit, and at that time, because the investment has already gone, so it will not show in the cash flow of a specific year. However, that investment need to be considered, and the cost need to be allocated to different years so that we can correctly attribute the cost of the production, and of course the profit, that is revenue after subtracting costs. We need to pay income tax, but that cost can also include depreciation, and they were or they are different kinds of depreciation method that we use. And then we talk about tax and going through different process of depreciation, taking consideration of depreciation. So in the tax computation, we can deduct the part of depreciation from taxable income, so that we can reduce the tax that we pay. In return, we got higher net income. Okay, but later we will see that net income is not our net cash flow, because we did not actually spend money on depreciation. It was allocated. The amount has already been spent at the beginning. So I think today we'll come to the point on developing net cash flow, because we will use net cash flow to compute net present value, or to determine whether or not we'll accept the project or not. And we'll use net cash flow can also be used to compute rate of return as well. But this is the last part that I did not finish on depreciation. I think depreciation, of course, we can depreciate the amount, but at the end of the project, chances are the asset still has value, and the asset selling or disposing this asset will generate some income, and this income may not be the same as the book value, so we need to adjust the salvage value at the end. And we were looking at personal property, real property, and for personal property, we follow this half-year convention. Right? If you remember that in the beginning and at the end of the project, we can also take half-year convention. So if we take MACRS in the beginning, it should be 40, but because we take 40%, because we take half-year convention, so there's only 20%. And this is second year, the third year. And remember that after we reach a certain point, along the way, we compare whether or not MACRS or linear depreciation give us better depreciation. If linear depreciation give us better depreciation, we'll switch from MACRS to linear depreciation, and at the end, we still take half-year convention. So this is for for a product having a 5 year of depreciation range, and we can distribute the depreciation into 6 years, and you add them together, it will still be 100%. But again, if the project life is shorter, for example, here the project life has only 3 years, so we take first year, second year, and third year, which was supposed to be 19.2%, we take ahead of it. Okay? So we can only depreciate 20% in the first year, 32% in the second year, and 9.6% for the third year. Okay, and if the project ended at the end of the 5th year, we do the same thing. For the last year, which was supposed to be 11.52%, we can only take half of it. But if the project lasts 6 years, it will be the same as the allowable depreciation following MACIS switching to linear depreciation. And the depreciation recapture, meaning that in the end, as I say, in the end, we will have salvage value. Okay. The salvage value need to be compared with book value. Book value means that every year we will depreciate certain amount, and at a certain point, if we dispose the asset, we'll get the salvage value. And the sale could be higher or lower than the book value. The salvage could be much higher, a little bit higher, or lower than the book value. So we need to adjust for that value, because otherwise we have depreciate. I just say a half of the value of the asset, the cost basis of the asset. So the tax system allow us to treat half of the asset, the value of the asset, as depreciation, and then we sell the asset. We get more than half among the asset value. Then we sort of in reality, we did not spend that much money on the asset. So that part of game need to be readdressed, recaptured, and we need to pay tax for that. Maybe we can look at the picture. It's a lot easier to understand. So this is cost basis for the asset. That is the amount of money you pay at the beginning of the project. And after certain years, then after the depreciation, this is the book value, tax book value, okay, for tax purpose. And however, later you sell the product for a salvage value. If the sale is lower than book value, we can claim the loss, because these are the amount of the asset we haven't claimed back. So if we sell at the end, it's lower, in that we lose certain value out of the product. So we can claim loss as business loss. But if we sell the product at a price higher than book value, however, we have already depreciated this amount. We have been able to reduce our tax based on the depreciation. And then this amount, additional amount, need to pay income tax. This amount need to pay income tax. But sometimes there are occasions where you acquire the product, the asset at the beginning, but after certain years, you sell the asset. at a price even higher than the cost basis. So again, we need to treat this part which have already been claimed for depreciation. So this amount you need to pay income tax. It's called depreciation recapture. The amount above cost basis need to pay a different tax. It is considered as capital gain, and you will pay a fixed tax. Usually it's quite high. Could be in the examples that we have, we always put 40% here. So this is a very high tax incident. Okay, how do you understand this? So more than cost basis, that you only have spent 10,000, then you sell it for 12,000. So you have additional 2,000 that you make out of the asset. So you need to pay both on income tax for the amount above the book value, and also for the amount above cost basis to pay capital gain tax. And this is the example. I think the main point will only be here. The property can adopt 7-year property class. Okay, so we'll come out with this distribution of depreciation, like 14.29% and so on. You can see clearly it's declining, using declining balance until this point. Then it switched to linear depreciation and following half-year convention at the end. In the beginning, it follows half-year convention too. So it should be, if we really follow declining balance, it should be 28.58. But we can only allocate half of it. So, but since the project only lasts for 3 years, so we'll take this first year following exactly the convention. Second year, the third year we can take only half of it out of 17.49. So that's our depreciation, and the rest of the computation will be the same. If we have salvage value higher than the book value, okay, here the book value based on the computation, the original cost basis is 230, and after depreciating these three amounts, right? So 230 multiplied by the addition of half of this, adding to this, come out to this. So this is the book value at the time, and the salvage value is 150. So 150,000 is more than book value 120, 693. So 29,000, around 29,000 need to pay tax. This is the tax. So the net proceed from the sale is not 150. It has to pay tax. So this is what we get from the salvage value. Okay. So later when we develop our cash flow for computing net present value, we need to go through this kind of computation. We need to be very precise on everything. We have revenue, we have expenses, and we said that which allow us to reduce income tax. and then we have net income. Okay, and up until that point, it's okay. But if we want to develop net cash flow for computing, for making decision whether or not to accept a certain project, is multiple years. We consider multiple years. In the beginning, we'll invest on asset. At the end, we'll dispose the asset, which has salvage value. So that salvage value need to be included in computing the overall net present present worth or net present value. Okay. But that salvage value cannot be taken as it is. We need to consider the salvage, whether or not the salvage value is higher or lower than book value, and how much higher. If it is higher but not higher than book value, this is the way we deal with it. Salvage value minus book value, that's additional amount that needs to be considered as depreciation, recapture. That we need to pay tax. This tax rate, you can go back to the tax table and see that this is where the tax bracket is. So you need to pay this percentage of tax. Then we subtract this tax from salvage value. That is what we actually get from the salvage value, from disposing the asset. Okay, we haven't reached that point, but at this point, I just want to point out that whenever we look at this as annual, like net income. But when we consider the entire project, we also need to consider the initial investment and the disposal of the asset. And at that point, we need to make adjustment. We'll probably see this. I think we'll see this almost immediately. And if you look at the example following the same kind of, there was a bar chart, which is a vertical bar. Now we have horizontal bar indicating different cases. Using the example we just had. So the cost basis is like this. This is the book value. These are the amount which have already been depreciated. If we sell the product at 150, more than 150,000, then this additional amount we need to pay income tax. If the salvage value is less than 150, then it's okay. Oh no, this is the salvage value side. And if it's less than this value, then we can claim loss. So our taxable income can be reduced so that we can still pay less income tax. But if the salvage value is much higher than book value, in fact, it is higher than cost basis, so we'll pay this amount above the book value. We'll pay again ordinary gain, tax for ordinary gain, and this small amount which is higher than cost basis will pay capital gain at the higher income tax rate. So here we are trying to know the income tax rate to be used in a project. Okay. Usually a company has multiple projects, and when we look at one project, we do a very simple summary of the the financial situation, we see that we have revenue at this amount, we have expenses at this amount, and we quickly come up with taxable income. Say, okay, so what is the income tax rate? For a company, their income tax are not for individual project. It's the sum of all the project. So you cannot just consider this income tax and consider its tax bracket and say that this is the income tax rate. You have to add the project to existing project and see the total fall within the tax bracket and attribute the tax caused by the last project and recompute the tax rate for the last project. Okay? Again, the business has some projects already, and this is the situation that they have: revenue, expenses, taxable income, income tax. This is their income tax, and they can compute their average tax rate. Now we have an additional project, and we are thinking of what is the income tax rate of this project. If you ignore this part, the existing business part, you will find the income tax and compute its tax rate. You are basically looking at its bracket, the taxable income, the bracket for taxable income. But when we evaluate the tax, the income tax, we need to consider adding this amount of the new project to the existing projects and see the last part, the additional taxable income fall within certain range, so that we can get the tax for the new project to be average or marginal income tax for the new project. So before undertaking the project, this is the situation. We compute the average income tax rate is 17.86. After adding this 40,000 to the existing projects, then we have higher gross revenue, higher expenses, and our taxable income rise from 70,000 to 90,000. We ended up paying 18,850 for income tax. Again, we use this income tax. We can compute the income tax rate. Here we can see that it's 20.94. But what is the income rate, average income rate for the new project? In fact, if we compute precisely, it's 6,350, and if you divide it to your taxable income, you'll find that you are paying 31.75% of the average income tax. Okay, but from this part to this part, you can probably tell that it must be higher, so that it raised the average income tax from 17.86 to 20.94. But how much? And this is what we can find. It really depends on where, again, where it falls. So original income tax is like this, taxable income like this, and at different bracket we need to pay different rate. this is additional taxable income, which bring our original taxable income to this point. And we found that part of this additional taxable income still fall within 25% of income tax range. And this amount fall within 34% of income tax range. And if you multiply this amount by 25%, this 15,000, this amount by 34%, and you get 6,350 as your income tax, and you divide this amount by your taxable income, you get 31.75%. Okay, that's what it actually need to pay for income tax. Okay, again, when companies computing income tax, and we don't look at individual project to find its taxable rate or its tax rate. We need to add them together. Okay? So this is a new project. This is additional income, taxable income contributed by this new project, and it will be added to the rest of the project, and we'll look at entire taxable income and to compute the tax, and different amount fall within different tax rate, 15%, 25%, and 34%. Originally, we only pay 15% and 25%. Now we have this additional amount. Some part of it we need to pay 25%. Some part of it we need to pay 34%. So if you take this part and compute its tax, which comes to 6,350 divided by taxable income, we got 31.75%. So it's quite high. It's not low. Okay, so this is just a quick wrap up of income tax. The reason we look at depreciation is for tax purpose, so that we can find precisely the net income. Remember, early in the class, I quickly go through 3 financial statements. One is income statement. There's a net cash flow statement. There's a balance sheet, right? Basically, these are the basics for accounting and for finance and for engineering economics. We don't go into a lot of details because there are a lot of implications, we think. But at least we need to know where the numbers come from. And here we are looking at net income, which is for income statement. However, when we compute present worth or net present worth, we need to look at the net cash flow. So that's for cash flow statement. So from income statement to cash flow statement, that is what we are going to talk about afterwards. Okay, so here we are looking at net income for income statement. So we are going to develop cash flow to compute present worth and future worth, or compute rate of return. So in order to evaluate certain project, or particularly here we are talking about investment decisions. In the beginning, we want to identify investment opportunities. That's also quite important. Right? You need to be able to see that there is opportunity. Of course, here we talk about investment opportunities, but sometimes it's not that clear that there is an opportunity out there. You need to actively investigate and understand that there is such an opportunity. For example, you work in a factory, you are making productions, and you are doing that every day. And sometimes machine broke, sometimes it's quite slow, sometimes it has quality issues. Then you continue to work on that because this is a machine that you just bought 2 years ago. Then you continue using it, trying to fix the problem. However, there could be some other opportunities, alternatives. For example, maybe there's a new technology, there's a new machine, which will cost you. However, if you can evaluate by replacing that old machine with a new machine, maybe it still provides enough benefit for you. Right? So that opportunity, you need to be aware. There are a lot of such kind of example. We typically, people are typically occupied by things which are more urgent and not thinking about the future, not thinking about other solutions, and they will be missing a lot of opportunities. So the first important idea will be you have to be able to identify the opportunities, either it's investment or other things. Then you need to generate cash flow for evaluation. Although it will get more and more complicated, and basically future cash flows are not easy to be certain. You can estimate, but it won't be very, very certain. Of course, we can first do all the analysis, and we say that may not be that certain. Then there will be probabilistic methods. There will be sensitivity analysis. There will be other methods like scenarios analysis, so that it helps us to get a broader picture of the situation. Then depending on how risky we want to take, then we'll make decision accordingly. Usually for people working on engineering economics, the only thing that we can do is based on the data and derive the result for further analysis. The decision makers may not take this factor as the only factor for their decision, but at least we need to show financially or economically this will be the situation. These will be the possible situation, so that the decision maker can reference to our analysis for making decisions. Again, these will not be the only factors or the only data for a company to make decisions. Okay. Let's look at the cash flow. Again, everything will be converted into cash flow in engineering economics. Otherwise, we will not be able to summarize the overall situation. Some things which are not measured in cash, we need to measure them in cash. Okay. There are different kinds of projects you can imagine. Here we are having these two classifications, two classes. One is called profit adding project. That is by investing into certain asset or certain process or certain opportunities will add value, will add profit. For example, we expand the current system so that we have additional capacity. We improve on the product so that the product can generate higher profit. Or we find ways to reduce the cost cutting, cost improvement project. Right? All these projects will help us to generate higher profits. There is also another kind of project called profit maintaining. Profit maintaining meaning that it doesn't necessarily generate additional profit. But we have a machine, and this machine maybe will replace a new machine. But that new machine is just replacing the old one. Old one is going to obsolete, and it will just help us to maintain the situation. It doesn't necessarily generate new profit. Okay, so replacement project and necessity project, we just need to have it. We just need to have, for this example, lighting. It doesn't generate additional profit, but we cannot do without lighting. And in terms of cash flow elements, you can imagine that easiest thing to think of it is we may invest on certain asset. We may investing on warehouse, additional space, new machines, additional machines, right? And those are outgoing cash. Right? These are payment. And we may also have something called working capital. Working capital is when you are running a business. You need to spend money for making product, paying your employees. But if the time for you to do that is earlier than the time that you will recover the costs, so the money will remain in the system. You cannot claim them back because your production is recurrent. Your payment to your employees raw material recurrent, and although your revenue is also recurrent, but there's a time lag, so there will be a certain amount of money. If it's big, then you have very big burden. If you can keep it small, then your burden will be smaller. But that is something that will happen, will remain in the system. Okay, it's almost like investment, because you won't be able to get it back. You will only be able to get it back when you decided not to run the business. And of course, working capital will vary depending on your the amount of product you are making, and the variety of product you are making, and so on. And for your investment, it could be you having all the funds and investing in the project, but it could also come from borrowed fund, meaning that it's from the bank, from other financial institution where you can borrow the money. However, you need to pay interest on that. Okay, that you need to be aware. And during the course of the production, okay, and of course, every year you'll do production, there will be cost, and sometimes from time to time, or for a longer period of time, then you have maintenance costs too. And of course, you may need to pay, or you have to pay income tax along the way, and you may have some leasing expenses. Oh, okay. And if you have borrowed some fund from some sources, you need to pay back the loan in multiple installment usually. So every year you need to pay certain amount back. On the other hand, with this project, maybe you are generating additional revenue. Maybe you are able to reduce certain costs, which can be considered cash saving, which will be income, consider income. And again, at the end of the project, you will dispose the asset. It gets certain salvage value, and also you can recover your working capital in the end. Okay, so in the beginning, somehow you spend certain working capital and to run the business, and it's a recurrence. So we just cannot recover them until the end. We'll recover it. Okay, that's probably the cash flow that we have. Of course, there are some more detail, but as of now, we have some investment activities. We have these so-called investment opportunity could be associated to this working capital too. And we have some so-called financial activity, borrowing money and then pay back the money. And the rest of them will be what we have seen earlier. That is, we are computing their net income so that we can generate net cash flow. Okay. And when we develop our cash flow, there are two approaches. In fact, they are the same. Just have very minimum differences. One is based on income statement. Income statement approach is just getting the income statement first until net income. Okay, but as we said earlier, depreciation did not actually happen on that year, so we need to add depreciation back to get net cash flow at that moment. Or we can compute directly, jumping out these computation of taxable income so that we reduce the depreciation. So basically, we compute directly to get cash flow. Okay, again, they are the same. It's just that if you don't want to sort of skip certain steps, this will be simpler. You follow the process until you get the income. Okay, the income. In fact, you have more than this as in terms of cash flow, but because depreciation is not a real cash flow, so you add depreciation back so you can get cash flow from the operation. And this is what I mentioned earlier in cash flow diagram. Usually, in terms of cash flow elements, we have operating activity, about the gross income, cost saving, manufacturing expenses, operation and maintenance costs, operating income, interest expenses. Okay, that's because you have borrowed certain fund, income taxes, which you have to pay. Investment activity, I mentioned about capital investment, I mentioned about salvage value investment. Working capital, you have to invest. And at the end of life cycle, you will get your working capital back. And if you have any gain on your salvage value, you need to pay gain tax. And financial activity will be money that you borrowed and the repayment installment. Okay, so these are basically possible elements for developing your cash flow, net cash flow. And once you go through all these items and coming out with your net income, then you can add your depreciation back, then you will get your net cash flow. Okay. So if you are working on a project, at least you need to look at all the elements in the company. This is a minimum at this point. Okay, let's take a break, then we'll continue. Okay. I think starting from the part on depreciation and tax, and the following chapters are more practical engineering economics that you can use for your project. Okay. So my suggestion would be, because you have different groups, right? Have you formed groups yet? Huh? Already? For project at the end of the semester? Have you formed project team yet? Okay. Exactly. I think you can form a project team and think of problem, and you can even discuss in the lab session. I think TA can help you to calibrate your selection of the project, and I have discussed with them that they can also identify certain analysis which are required in the project. Okay, so that they can go through the process. So you can also discuss with Yang and Kyra. Okay, so in the lab session, you can bring up your ideas of the project, and maybe you can even do a very simple presentation there. And TA can help you to calibrate the contents, the scope, and they will help me to assign you certain process that you need to go through. For example, if we said that we require you to generate net cash flow, and you need to start from getting revenue, expenses, cost, investment, whether or not you borrow the money, and how much working capital that you need to have. And I think there will be an example showing you how to come up with the working capital requirement. Okay. So as I said, the contents starting from depreciation, tax, and cash flow development. These parts and later parts are mostly more practical engineering economics, and these contents, it's difficult to give you as exam problems, but I think they are extremely helpful for your future work. So we will assign them as requirement for your projects, so that you can use these methods of developing cash flow and developing analysis to make decisions on certain opportunity or alternative that you want to evaluate. Okay, so yeah, we mentioned that these are the elements of the cash flow. A lot of situation we may not have this financial activities, okay. But for sure we'll have investment activities. Right? You need to invest on the money before you can generate profit. So there will be this investment, and for sure you will have this operating activities. You invest money, build everything, could be factory, and then you start to run your business. And running business will have costs, will have revenue, and you have to pay tax, and you need to issues. So another way to look at the two approaches I just mentioned. One is using income statement to get net income. Right? Income statement. In income statement, we have revenue, we have expenses. Expenses. Again, you go back to income statement. Probably chapter 1 or chapter 2 of this course. For expenses, we have variable cost, which is cost of goods sold. Depending how many items or how much you sell, then it will be cost associated with them. And you have chances are you have interest that you need to pay. Right? If you borrow the money, you have interest that you need to pay. But of course, you have repayment of the principal, right? But with different installment. But interest will be considered in income statement for debt interest. Then operating expenses. So this is operating. This is the cost of the product, depreciation and debt interest. Then subtracting revenue, subtracting expenses from revenue, you get taxable income. Then you get income tax. Then subtracting income tax from taxable income, get net income. So net income will come to cash flow statement at the top. Then you need to again add depreciation back. So this is the income out of operating activities. Okay, previous page we see operating activities, we see investing and financial, and operating part can be obtained from income statement. Again, you get net income out of income statement, add the depreciation back, you get the total financial situation for operating activity. Then you look at capital investment, you pay, which is minus, and you get proceeds from sales of depreciated asset, as we have already shown just now, from your salvage value adjusted by adjusted salvage value depending on the exact value of the sales against the book value at the time, right? Then you have to subtract income tax, so that you have to subtract working capital, and maybe in the end, in the beginning it's like this, in the end you'll get your working capital back. And if you have borrowing fund, this is the activities also in cash flow statement. You may not have them in different years, but at the end you will come back, and you have borrowed the fund, which is at the beginning, and you have repayment of principal in different years. So that these are different elements will give you net cash flow over different years. So we can look at one example, and hopefully this example can help you to see how cash flow can be developed. This is a project of installing a new computer control system. Okay, so chances are it will generate, well, in this particular case, it will generate so-called labor saving. Okay, reduce the cost, labor saving. So this is additional money that we'll get. Then there will still be this annual expenses. There's a salvage value And project life is 5 years. Although for the new computer control system, the depreciation method is 7 year MACRS, Modified Accelerated Cost Recovery System, MACRS. But the project life is only for 5 years. A lot of these situations we have seen previously, so I think we can connect them together. And income tax rate, to make it simpler, is 40%, and MAR is 15%. Okay, so this is, in terms of project, this will be like something that you can think of. Like right from the beginning, you have some simple data that you can run. Here there's no borrowing activity, so there's no financing activity, but there is investment activity. Here there's no working capital activity too, because we don't have the data. But here again, it's just very simple investment, and there will be depreciation, there will be tax, there will be salvage value adjustment, and we can come up with the net income. So here, to go through the analysis, first of all, we need to develop the project's cash flow over its project life, which is 5 years. Okay. A second question we can explore is the project justifiable at the MAR of 15%? MAR is what we know that our company can, any investment together will get this kind of return. So any new investment, if we want to take any additional investment, its return has to be higher than 15% MAR. That's the meaning of minimum attractive rate of return. And we can also compute the internal rate of return for this project. Okay, so let's try to go through the analysis, development analysis. So first of all, we are taking 7-year MACRS, and if you still remember, we take half-year convention. That is in the beginning, and at the end, we can only take half of whatever value it was computed. This MACRS was from double declining balance switching to straight line methods or linear depreciation. So this is half of 28.58%, right? And gradually becomes smaller until this point. If you go back, you will see that at this point, if we consider to use MACRS, the depreciation amount will be lower than 8.93. So switch to straight line or linear depreciation, and with remaining depreciation and remaining years, so we use that percentage divided by 3.5. That is how we get 8.93, 8.92, 8.93, and the last year, half of the previous year. All of them adding together, and all of the depreciation rate added together for original declining balance, they should come to 100%, and we can depreciate them year by year. So depreciation amount based on 125,000, and because MACRS particularly for we assume that salvage value is 0, so we will depreciate all of them. So the total cost basis is 125,000, and we can use this, multiply this value to get depreciation amount for each year over 8-year period. However, our project ends at the 5th year. Okay, only 5 years. So the first year, second year, third year, and the fourth year will be identical from what we have already computed based on MACIS rate. But the 5th year, because we are taking this half year convention, so 5th year we can only claim half of the amount that we computed from MACIS. So it's only half of 11,150, which is 5,575. So these are the depreciation we can claim over the 5-year period. So we can look at the computation. Okay, we saw previously that salvage value will be 50,000, and the book value at the end of year 5. Okay, book value will be cost basis minus total depreciation. That is the sum of all these depreciation which have already been allocated and used for lowering the income tax. So you sum them out, it's 91,525. And so cost basis subtracting depreciation, we get book value at the end of the 5th year. This is the book value. However, that's also the end of the project where we get 50,000 as salvage value. So there's a difference, and our salvage value is greater than book value. So we'll be subtracting, computing the difference. The difference is 16,525, which is required to pay to pay income tax. Again, to simplify the computation, we were given a tax rate which is 40%. So this gain is to pay 40%, and we computed the 6,610. Okay, so this is the tax for this for the salvage value. Okay, so we need to subtracting this amount from 50,000. That is the amount that we'll get. Okay, but before that, we'll start from income statement, as you have already seen. Right? We'll start from income statement, then we add other cash flow into income statement. In income statement, the simple part of income statement, we just look at the operating activities. We have revenue every year. We have labor, material, overhead. We have depreciation. These are the expenses. Okay. Other than depreciation, for all of the years, they are the same. For depreciation, we have computed for each year. And again, if you remember correctly, the last year we can only depreciate half of the depreciable amount. So we have 5,581, which is lower. And we do the subtraction, then we get taxable income for each year. And each of them will need to pay income tax, again, to simplify the computation. So these are how we come up with the income tax. And subtracting income tax from taxable income, we got net income. Okay, these are for operating activities. Okay, operating activity. Then we can look at cash flow statement. We'll take net income from the previous statement. Right? So these four values, these five values, if you compare, come from the bottom. These five values. And now we are looking at cash flow. So we need to add depreciation back because depreciation did not happen. It wasn't something that we paid, but in the income statement, we compute net income. It's for the company to understand their income for after considering tax purpose. But for cash flow, we need to add this back because this money we did retain. Okay. So operating activity, not just net income, we also have these depreciation added back. But in terms of investment activities, in the beginning, we have 125,000 that we invested. Okay. And we have salvage value at the end of the 5th year. But the salvage value need to be adjusted. It's called depreciation recapture. Then, because the salvage value is higher than the book value, and the book value based on the additional amount we need to pay tax, and we have computed that we need to pay 6,610 for the tax. So it is a minus term. So we sum all these cash flow to get the true net cash flow at the bottom. So 125,000, and these two values added, these two values, and so on. For the 5th year, at the end of the 5th year, other than net income and depreciation, we have salvage value, but reduced by 6,610 tax that we need to pay. So in the end, we get 81,622. So these are our cash flow, net cash flow. Then we can compute its present worth. Before now, all these values were given, and we just need to compute. Now we are talking about how we can generate these values properly. But still, this is just part of the process. The process can be even more complicated with more elements included. So what we can do now is we have investment. We can so up until now it seems to be like this, because this is how we write the statement. Right? We write the statement, so we do it for each year. This is when we do cash flow statement, income statement, we do it this way. But when we are doing engineer economic analysis, we are trying to develop the compute the net present value or present worth. But usually like transpose the matrix. So years. Earlier, when we look at engineering economic analysis, we always put years as the role, right? And items that we want analysis, we put them as columns. So this is just the transpose of the previous table. And here, we'll write for each column the elements of cash flow. So in the beginning, it's investment at year 0. And then we have revenue for each year. It's the same. Labor, materials, overhead, depreciation again. Taxable income that we had. Income tax, right? We have computed. Then, in the end, later we have this income tax also from salvage value. So not only these 4 years, we also have income tax there. And it was also based on salvage value. Okay, salvage value. And this is book value. This is depreciation, book value. Okay. This is difference. And this is the tax. Okay, so this is the salvage value subtracting income tax to get this value. Okay, so these values are okay, but this salvage value need to be added to the end of the 5th year. So this is how we develop these cash flow. And here it shows how to compute different values. Yeah, because we have already known that, so here it's just a symbol. In fact, with this symbol, you can sometimes reorganize them so that you don't need to go through them step by step. There's a simplified way that you can generate income tax and net cash flow. But anyway, here we just follow a regular way of doing this, and we have depreciation, so we get taxable income. And once we get taxable income, we can compute income tax, and then taxable income subtracting income tax, we get net cash flow. And only the last year, because of the salvage value, we need to check on the book value, which is depreciation amount, and this is taxable income, computed the tax and adjusted from 50,000 to get 43,000. So this is how we can get the cash flow. Net cash flow in the end. Okay. But here, although we do computation here there's no year. So this is just for our computation purpose. So once we finish this computation of the salvage value, adjusted salvage value, the actual amount that we'll get, in fact, then we'll add it back to the end of the 5th year, because it happens at the end of the 5th year. So it will look like this. In the beginning, this is the investment. And every year, this is the net cash flow. The last year, it was lower, but adding its salvage value, we get 81,622. So that's our net cash flow shown in cash flow diagram. And it is clearly a simple investment. We have a negative value in the beginning, and all other cash flows are positive. So it's a simple investment. But anyway, before doing simple investment, our question 2 is, if we assess this project based on the MARR, minimum attractive rate of return of 15%, will we accept this project or not? So minimum attractive rate of return is 15%, and we compute its present worth based on 15%. And this is initial investment. Second is 43,145 given F by T, 15% for 1 year. So bring all these other value, this cash flow, to the present time. We sum them together and get 43,151, which is greater than 0. So if we evaluate this project against 15% of minimum attractive rate of return, we'll accept the project. Okay? So the cash flow will be evaluated based on a certain MAR value. And if it's greater than 0, the present worth is greater than 0, meaning that our investment or this opportunity, this project opportunity will generate higher than 15% of return. Okay, we have looked at this example before. At 15%, we evaluate the present worth. It's a big positive value. Then we can continue to increase MAR. We can take it to 20%. 20%, meaning that we are evaluating the project against MAR value equal to 20%. If it's still greater than 0, then meaning that it's greater than 20%. Okay. But the value will get smaller and smaller until a point where the MAR value will result in 0 present worth. Then if we continue to increase MAR, for example, we increase MAR to 40%, chances are the value will become minus. Which also means that if we are evaluating this project against an MAR equal to 40%, this project does not generate a return higher than 40%. Okay, you can interpret the project based on MAR value. Okay, so again, 15% is positive. This is a very big positive number. So chances are we can increase to 20%, it will still be positive. 25% maybe still positive. 30%, I think chances are it will be positive until a point where it will make the present worth equal to 0. Okay, that MAR is in fact the rate of return of this project. Right? So as the MAR continues to grow, then we can say, okay, it's higher than that. The return is higher than that. Until it becomes 0, then we know that's the exact rate of return. Then if we continue to increase the MAR, it will become negative, which means that it will not generate that kind of return. So that brings us to the third question, that is, what is the rate of return for this project? And I have already described when MAR is 15%, it's a big positive number. Even if we increase it to 25%, it is still a positive number. So you know that the project generates return higher than 25%. But then when we put 30% as the MAR, we found out that it's already negative. So we know that the rate of return should be between 25 and 30. And we can continue to change the number and do interpolation. Eventually, we found out that the rate of return is 27.61%. Okay. So if we use the previous methods against 15%, we compute. Present worth is greater than 0, we accept it. If we want to use rate of return, we can compute the rate of return. We found that the rate of return for the project is 27.61%, which is also greater than 15%. So we'll accept the project, the opportunity. Here, because it's a simple investment, there's only one negative cash flow, and the rest of them are positive cash flow. We know that it's simple investment. So we are sure that we can compute a single rate of return, which is the internal rate of return. So we do interpolation and get the value, and we do comparison. Again, if it's not simple investment, or if it's borrowing, or if it's non-simple borrowing, right, and there's a so-called complex cash flow, and we cannot just use interpolation because there could be multiple routes. So we cannot use a rate of return for evaluation, at least not directly. Okay, so that's 27.61%, which is internal rate of return. If we track the book value, the project balance, which is the book value, and we can see that original is 100. It's something that we have shown earlier. That is, we have certain investment, then we continue to accumulate more value based on 15%. Then we have some return. Then we'll continue to accumulate certain time value or interest. Then we have certain return. So year by year until the last year, right, we accrue certain interest. Then with the income, we bring it back to zero. Okay, so 27.61% will result in this kind of project balance situation. If you draw the cash flow diagram as I have just shown, again, it will be down. Getting smaller and smaller, and last part bringing back to zero. Okay, this is what it shows if you look at the project balance. If the project requires working capital, okay, working capital, when I use an example to describe it already, right? Before we sell the product, we need to hire people. Like if we look at the year, we need to hire people. We need to buy raw materials, right? Then after a while, we can sell the product, and we may not sell all of the product. So we have some inventory. So we are keeping this process as a recurrent process. We always have this time lag of recovering the cost. That amount is the money that we will not be able to get it back. So that amount is something that we need to put in the project as the investment, but it's considered as working capital investment. Only after we finish all the project, then we will be able to recover the so-called working capital. Let's see. Okay. So this is the setting of an example that we have. We have revenue per unit is 10. That's if you sell an item, it's 10. We have variable manufacturing costs, labor, material, overhead, as you can see. So it's 2.2. 2.2. Revenue is 10 per unit. Variable cost is 2.2. Monthly volume is 833 units. Very strange unit, because if you multiply by 12, it gives you 10,000 a year. Okay, so if we look at it monthly, it's 833. If you multiply this value by 12, it give you 10,000 a year. Finishing good inventory to maintain, you always keep 2 months of supply. Okay, so there will be 2 months of the product that you cannot get the money back. Raw material inventory to maintain, 1 month of supply. Account payable is 30 days you need to pay. But account receivable, after 6 days, then you will get the amount, right? So that's the difference between these two. So if you computed sales annually, you will sell this amount. You are supposed to get this amount, but there are 2 months. 2 months inventory that you cannot get yet. Account payable is 2 months. Similarly, for expenses, this is the amount of inventory that raw material that you will spend. But then you have to pay additional months, because previously you see that you have to pay 1 month account payable, account receivable. So there's a discrepancy. So income tax, based on this computation, because this is reflected on our sales and our cost. The tax agency do not consider your account receivable or payable part. Basically, this is the sales that we have. This is the expenses that we have. Okay, so we get the income tax. But in reality, this is what we actually receive, and this is what we actually pay. But we are still paying this tax. So these are the true cash flow. And the difference between what we can see on the book for the tax purpose and what we actually, the cash flow actually are, there's a discrepancy. This discrepancy is our working capital over different years. It will remain to be there until you finish the project. So for the first year, you will find that this seems to be the situation, but this is the real situation. You only get this amount back. So this amount, although for tax purpose, they think that you have made this amount of money. But in fact, this is what you really made. And this amount will be there, will be the expense, continue to be in the process until you end the project and the working capital can then be recovered. Okay, if you look at this one right here, so the rest of them will be the same, because again, as we computed previously. But here, investment investment activity, originally we only have 125,000 for the initial investment, but now we'll add working capital, because this is the discrepancy which we cannot recover. So we just consider that, well, we have paid this amount. It will be used like currently until at the end of the project, then we'll get this amount back. Okay, so working capital as part of investment activity, money goes in the beginning, we get the money back at the end. Although the numbers look the same, the value of the the working capital that you recover is a lot less than you put in the beginning. That you need to understand. So that's why I said previously, we'll try to minimize our working capital. Right? We'll minimize our working capital by maybe you will delay your payment to your supplier, right, until you have your sales or the account receivable that you receive, so that you don't need to pay them. Right? That's so that you can reduce your working capital, reducing the burden of losing the value of your money as working capital. Again, it look like the same, right? The same, you recover the same amount, but because the time value of money, the amount that you recover has already been depreciated after 5 years. So that amount, if you consider 15% of MAR, the amount becomes a very small value already. So we can compute based on this. So we have again, original net cash flow. Then we add working capital. So in the beginning, this is our working capital. In the end, this is the recovery of the working capital. So if you add them together, if you compute, then you will find. You can find the new net present value, okay, or the present worth. Maybe I just pointed out another thing. It takes about 1 minute. The borrowed fund. Okay, remember that earlier we talked about borrowing money and return the money in equal installment over an extended period of time. So in this particular case, it will be borrowing a certain amount so that we do investment. Then we return the amount to the, let's just say, the bank. But for each installment, some part will be interest, some part will be return of the principal. So the return of the principal cannot be considered, because your principal or your investment will be allocated as depreciation, as a tax deductible term. So what we need to consider will only be the interest that we are paying. So we borrow a certain amount of money and we have equal installment for 5 years. Each year we have different portion of interest. Interest will be less and less. Principal will be higher and higher in terms of return. And we don't need to consider principal. We only need to consider interest, because principal, add them back, it will be the borrowing amount used for investment. They will be considered in the depreciation already. So again, if we borrow a certain amount of money, then every year we'll pay certain amount back, but some part will be interest, some part will be principal, return of principal. Okay, so we get all the interest, all these interests, but the interest can be considered as expenses, so that we can further reduce taxable income and reduce the tax. Okay, and the borrowed amount will be considered in so-called financing activity, which is an additional activities. And these amount will be placed in financing amount as principal. Okay, so that these are the breakdown of the installment, principal repayment, and debt interest. These two will be added. If you add them, you'll find that they are of the same value. So that's equal installment. But part of them will be interest, which will pay less and less. The return will be higher and higher. They will not be placed here for deducting as expenses, because these part have already been considered in the investment and were allocated for depreciation already. So we cannot further treat them to reduce income, taxable income. Okay, so we will only consider interest here, and these parts is still considered as financing activity, but they will not be placed here to allow further tax reduction. Okay, I think with the financing activity, is basically breaking down interest and principal repayment in two parts and put them in different places. And again, we can compute the new net cash flow. Okay, so it's getting a little bit more complicated, and it's not. I think the textbook and most of the textbooks do it this way. At this point, we sort of sum them up in this way, but then later there are additional factors which they will not be included in this part because it would be too complicated, but they will focus on other issues to address. But when we do analysis, we need to bring them to this analysis, adding them more and more to this table. Okay, let's take a quick break, then we'll continue. So again, here from the original analysis, now gradually we add more and more elements, right? We have depreciation, we have salvage value, right? Depreciation we capture, we have working capital, now we have borrowing fund and financial activities. And in each category, here we have operating activity, investment activity, financial activity. We can even increase more. The process will be starting from, usually we need to have this annual things. So we'll start from looking at income statement. We have revenue, expenses, and we need to sort of combining this income statement and cash flow statement together so that we can come out with the right net cash flow. Once we have net cash flow, we can easily evaluate this project against certain MARR. Right? So here, again, it's a simple investment. The first term is negative, the rest of them are all positive. So we have a simple investment. So we just use the MARR, compute its present worth to see whether or not it's greater than 0. If it is, accept the project. If it's not, reject the project. And again, if there's a new situation where we have negative taxable income, okay, so this project is losing money basically. So if we add this you look at this, so, oh, okay, yeah, we sort of wasted this depreciation and so on. But that should not be the case. This amount will be added to your regular project. Okay, so it will reduce your taxable income and increase your well, it doesn't cause that much damage. That's why I meant it is losing money, but help you to reduce maybe the higher part of your taxable income. So your income tax maybe in general will be reduced. So original the project is in negative term, but then added back. So your original income tax was from 35 million reduced to 31.5 million. Okay. And we can, as I said, we have two approaches. One is from income statement. The other is from cash flow statement. And from cash flow statement, we sort of jump over a few computation. But if we list their relationship, and I have already described that, if we sort of simplify the entire relationship, we should be able to simplify that relationship and come up with some simpler way to compute different values. Okay, so this is a result of computing that simpler way for resulting these values, and and we can either go into the process that we have gone through, or in the process describing their relationship and simplify the relationship to get the result. So if we do that, we can also compute the net cash flow directly. Okay, so I won't go through the detail because they are exactly the same. Exactly the same. Just that they are exactly the same. If you use a simpler way to look at them, one is going through the process and compute net income, then add the depreciation back. So we have gone through all the details. But these are processes have some relationship. You can write them up and simplify the relationship. And you can convert this to this table and compute this value directly. Then you sum them up. You will still get this cash flow directly. So the last 2 pages, we're talking about this. How not to go through the entire process. Instead, using the relationship that we have developed and computing the cash flow directly. You can try by yourself. Okay. Which is also consider this kind of computation to get this salvage value. Similarly, for this value, right, taxable income is something subtracting something. Right? Income tax is taxable income multiplied by a tax rate, and net cash flow is the subtracting of these two. So we have all kinds of relationship among them, and we can simplify them so that we can obtain directly. See, these are the relationship. These are the tax rate. So we can apply them directly in the computation to get the result.